Hello, here we go. Continuing on, let's see what clip this is in chapter 2. Should be on clip 3, slides 19 through 27. Chapter 2. So we started looking at fixed income securities. We looked at treasuries and agencies and municipals. So we were looking at government fixed income or debt or bonds. And now we're going to look at corporates. All right, corporations that issue bonds. And we became very familiar with that in chapter 6, I believe, in managerial finance. So corporates. So corporate bonds are issued by industrial companies, utilities, transportation companies, and finance companies. All these are the major issuers in the corporate world that issue corporate bonds. All right, and what do they do with the money? Well, largely they fund plant and equipment, and also they fund working capital for the companies, and in the case of finance companies, they help fund loans. The finance companies, like let's say American Express, they'll issue bonds, they'll pay 5% on their bonds, they'll loan that money to credit card customers and charge them 18%, kind of like a bank. So they make a very nice margin on their bonds. All right, so let's look at some different types of corporate bonds. We have mortgage bonds. Mortgage bonds are bonds that are secured by specific assets owned by the company. Okay, and this means that the assets can be sold, and the proceeds from the sale can be used to pay off the bonds in the event of a bankruptcy. So it makes the investor feel more secure, and they charge a little bit, they'll demand a little lower interest rate for bonds that are secured by specific assets like mortgages. And by the way, let me just tell you that a mortgage is a loan that is backed by real estate. Okay, debentures. What is a debenture? The issuer does not pledge specific assets to secure the loan, okay, as collateral. Rather, the bonds are secured only by the promise made by the company to repay. Sometimes they're called promissory notes, sometimes they're called signature loans. Signature loans. So there's no specific collateral. Then we have subordinated bonds. Subordinated bonds, so we're going farther down the totem pole here with regard to security on the bonds, leftover assets in the event of a bankruptcy. What this means is that as you get into subordinated bonds, and there are usually two types, junior and senior subordinated bonds, you have less and less security, and there's a higher likelihood that in the event of a bankruptcy, you, the bond investor, will not recoup your money. Okay. All right, then we have convertible bonds. Convertible bonds. And these are bonds that can be turned into the issuer or the company in exchange for a specified number of common shares. So it's written in the contract, for every $1,000 bond that you buy, you can exchange that bond contract for a certain number of shares of our common stock. Okay? Here's an example. Company issues a 10-year convertible bond that pays 7% interest annually, and that's the coupon payment, or the coupon rate, excuse me. And the principal is $1,000, and it's convertible into 40 shares of stock. So you can take your bond contract, go to the company and say, hey, I want 40 shares of stock instead of the bond. All right? And so if you divide the $1,000 by 40 shares of stock, what you get is a break-even price of $25 per share. So anytime the stock is selling for more than $25 per share, then 40 shares of stock are worth more than the $1,000 bond. Okay, so that's how that works. Recognize that people buy bonds for stability and for income, and they buy stocks primarily for total return. So if you're a bond holder, you may not want to convert your bonds because you don't want to take on that risk. Now you may, and also know that if there are a lot of convertible bonds out there for a company, and the stock goes to 28, a lot of people who own the bonds are going to be converting their bonds into stock, and then what are they going to do with the stock? Sell the stock. Well, if the supply of the stock goes up, what happens to the share price? It's probably going to go down. All right? Let me check and make sure that we're recording properly. And it looks like we are. All right. Okay, so convertibles. All right, let's take a quick look at international bonds. We don't do a lot of international bonds here in the United States. At least at a retail level, when you're working with individuals, you can buy them in mutual funds, but let's take a look at international bonds. And so they are designated or identified by the country of issue. Where is the issuer? In what country? Germany, France, Japan, the United States. They're identified by where do they trade. Maybe they're issued in the United States, but they trade in London. And in what currency are the bonds denominated in? The currency, okay? And so let's take a look at euro bonds. Euro bonds, okay? These are denominated in currencies not native to the country of issue. Okay, so you have, let me give you an example. Maybe denominated in dollars, sold outside the United States to non-U.S. investors. Okay, and here's an example. General Motors decides to raise capital in London. Okay, and so they sell GM bonds that are denominated in dollars, but they sell them to British investors. Okay, so that would be a euro bond. Then we have Yankee bonds. Yankee bonds. These are also denominated in U.S. dollars, sold in the U.S., issued by a foreign corporation or government. Example, and what this does is for U.S. investors, it eliminates exchange rate risk, which we looked at before. We know that exchange rates introduce another layer of volatility of risk, and so if you're a bond investor in the U.S. and you're interested in owning an international bond but you don't want to take any exchange rate risk, you might look at buying Yankee bonds. And so here's an example. Samsung bonds sold in the U.S. denominated in dollars. So very similar to the U.S. selling euro bonds outside of the U.S. All right, and then we have international domestic bonds, and they're sold by an issuer in the country of issue, in the currency of issue, and it has exchange rate and risk for foreign investors. And what that means is we decide in the U.S. that we want to buy Japanese bonds, we go over to Japan and we buy them. Okay, we just buy Japanese bonds. So there are different ways of getting involved in international bonds. Okay, so here we go. U.S. investors buy Samsung bonds denominated in yen. All right, let's take a look at the last area in fixed income, which is preferred stock. Yes, even though it says stock, typically people classify preferred stock under fixed income, okay? Under fixed income. There is a periodic payment. It is not called interest, it's called a dividend like common stock. The dividend has to be declared by the board of directors each period. Unlike a bond, where there is a contract and a schedule of bond payments, and each payment is a legal obligation, the dividend of a preferred stock is not a legal obligation until the board of the company, the issuer, meets and declares the dividend. All right? So those dividends aren't legally binding, but boy, if you miss a dividend payment, man, the price of this preferred stock will get hit really hard. All right, let's shift over into equities. Equities, and what we're talking about really are stocks. And you will note that the returns are not contractual like bonds. There's no guarantee. We don't know the amount and timing of cash flows. And so the returns do fluctuate. There's a lot more volatility in stock prices than in bond prices. So the returns fluctuate sometimes, most often over a longer period of time. Returns on equities, on stocks, much better than returns on bonds, and that's because there's more risk involved. Okay, so let's take a look at common stock. What is it? Well, it is pro rata ownership or proportional ownership of a firm. The returns come from the dividends that the company may pay, which is extra cash, i.e. in earnings that the company has, that they feel like they can send off to the owners as opposed to reinvesting in the company, and from increases in the stock price and capital gain. Okay, so that's where you get your returns from, and both of which are related to the earnings success of the company. When you buy a stock, you are betting on the success of the company, and you're betting that you are paying a low price for the stock compared to the success of the company. So please understand that there are two dimensions, at least two dimensions, to making a smart investment. One is the actual success of the company, and the other is paying the right price for the investment up front, so that if the company is successful, your asset will be worth more than what you paid for it. Okay? You have to have both of those. And we'll get into that in more detail as we go through the semester. All right, excuse me. So, stockholders have the rights to their pro rata share of the company's earnings. Okay? So, if a company declares a dividend, you own 10% of the company, you get 10% of the dividend. Okay? And to the proceeds, if part or all of the company is sold. And so companies are all the time adding to their portfolio of businesses and selling from their portfolio of businesses. And if there's extra cash involved that's available, you get your share if you're a stockholder. Stockholders get to vote on important company issues. Just a little bit of commentary, I would say that companies do not offer enough opportunities to investors to vote. In other words, more issues should be brought before the stockholders to vote on, in my opinion. Okay. Who issues common stocks? Well, the same folks who issue bonds, industrials, utilities, transports, and financial services companies all issue common stock. All right. Let's look at foreign equities quickly. Foreign equities can be purchased in three ways. If you're interested in diversifying your portfolio, it's much easier today than it was 20 years ago. Three ways to purchase foreign equities: what we call American Depository Receipts, ADRs, very common. And these are certificates of ownership, kind of like a stock is a certificate of ownership, issued by a U.S. bank that holds shares of a foreign stock in safekeeping. And so they may have 100 shares of Samsung, and they may issue a certificate against Samsung stock. That's one way to own Samsung stock. Okay? At the end of 2007, there were 256 of these listed and traded on the New York Stock Exchange. Okay? At the end of 2014, there were about 1,400 American Depository Receipts trading in the over-the-counter markets in the U.S. So there are a good number of large foreign companies. In several of the portfolios that I manage, I own L'Oreal, which is the cosmetics company, and I own Nestle, the chocolate, the food company. Okay, and those are ADRs. Don't actually own the stocks, own the ADRs. The stocks aren't available in the U.S. Okay, speaking of directly purchasing or selling a foreign security, you can go overseas to an overseas exchange and you can buy these foreign securities, either in the country of origin or on the exchange of another country. And we're going to look at the exchanges, I think, in the next chapter. Maybe even in this chapter, we'll see. So that's kind of like buying a French stock on the London Stock Exchange or on the New York Stock Exchange. So you can directly purchase some foreign stocks. At the end of 2012, there were 263 foreign stocks listed on the New York Stock Exchange. All right? And then the last way to buy foreign equities is through mutual funds that specialize in foreign stocks. We have global funds, and we have a chapter on mutual funds, on investment companies, which is another term for mutual funds. There are global funds that invest inside and outside of the United States. That is a global fund. So if you already have U.S. investments and you want international investments, you don't get a global fund, you buy an international fund. So an international fund invests exclusively outside the United States, and a global fund includes the United States. So watch out, you don't want to double down on your U.S. investments. Okay? Then there are funds that focus on geographic regions like Southeast Asia, okay, or South America, maybe Central America. And then there are funds that concentrate on individual countries, like instead of Southeast Asia, maybe you want to focus on China, or maybe you want to focus on Japan, maybe you want to focus on Mexico. So you invest in a fund that focuses on a country instead of on a region. Okay, that's it for this clip. We'll take a pause now and come back and look at special equity instruments in the next clip. Until then, peace out. Shalom.